Hello, everyone. I wanted to discuss the stock market volatility in the US that we have been witnessing over the past few weeks and months, and the pullback that we are seeing, which so far is just a minor correction in the grand scheme of things. At least that's my opinion. It has already caused it's already causing a lot of frustration among index investors, and every time you turn on CNBC, you can hear the negative headlines about a recession, an incoming recession. I think it was today or yesterday that the Goldman Sachs improved lift up the probability of a recession to about 30%, 39%. Don't quote me on that, but it was just ballpark. And so what I wanted to say is that if you've been following me across social media, then you definitely know that I've been pounding the table on this. The US market has been ridiculously expensive for the past years. And sure enough, when it gets to a price that it just becomes unbelievably ridiculous, sometimes all it takes is just an event. And it may not be something like a war that's breaking out, a new war, but remember, it's priced for perfection. And so anything that happens can cause the prices to tumble. And I think we are starting to see something of that kind, which so far hasn't translated into a major depression or anything. I'm not suggesting that's going to be the case, but remember that with the Nasdaq down 20% because it's market cap weighted, it means that all these high flying tech names, many of them at least, are down 60, 70%. Some of them are even down 80, 90%. So there's been a lot of wealth destruction behind the scenes. And I think I wanna go through a few charts with you to show you exactly why, what kind of indicators I'm looking for whenever I want to have a better, higher level understanding of the macro picture. I'm a bottom-up investor. Okay, most of my decisions are based on fundamental analysis. However, I like to understand what's happening across the world in terms of the economy. Of course, it's important to stay up to date. And this is the Wilshire GDP ratio, also known as the Buffett Indicator. The way we calculate this is, you can see right here, you do the total value of publicly traded stocks divided by the GDP ratio. This is in the US, by the way, okay? And you can see that from a historical standpoint, we were at the highs around December 2024 at nosebleed levels. So this means that US stocks as a proportion of the country's GDP was at the highest it had ever been. All right, that's how expensive this thing was. And even though we just had a pullback right now, look at that. They still represent 191% of GDP, which is unbelievable. Look at what happened in 2000 during the tech bubble, in 2007 during the global financial crisis. We are way beyond those levels, way extended. And if we just were to revert to the mean, you can see that we have a long way to go. There's a lot of downside still. Not once again, I'm not suggesting that's going to be the case, but it makes you think about it, right? Because it's possible. And another indicator that I personally follow, let me just, and this one is probably one of my favorites, is the Shiller PE ratio, which you can see here is the price to earnings ratio based on average inflation adjusted earnings from the previous 10 years, which is also known as the cyclically adjusted PE ratio. Look at the median, 16. That's the median. Right now, even though we just pull back, we are still at 34.75 times earnings on the S&P 500. I mean, this is unbelievably expensive. Look what happened during the 2000 bubble. That's where we reached the highest point at about 43. Yeah, so you can see, 43.21. But for example, in 2008, we didn't reach those levels, and now we are definitely at one of the highest levels, since 1880, which is unbelievable, and it goes to show how dangerous this market is. And even more so, if we consider that almost half, look at this chart that I wanted to show you as well. Look at this. This is the S&P. This is gains. No, not this. This is not the chart that I wanted to show you. I wanted to show you another chart which I'm not finding it right now, but essentially it tells you that in 2024, last year, about 40% of the S&P 500 gains were driven by the big tech companies. And what we are seeing right now is that those companies that led the markets higher are now leading the markets lower. And it's not a coincidence that if I go here to my virtual account, you can see, for example, that names like Meta, Google, Amazon, all these high-flying names are trading lower. Look at Google, for example. Google is already off, what, 30% from the all-time highs? Yeah, 25% from the all-time highs. In a company that is worth, what's the market cap of this thing? Is this 1 trillion, 2 trillion? We are talking about trillion-dollar companies. And so to see a 20% drawdown in one of these companies, you can see the wealth destruction that's been happening. And so people who are buying were buying them at the top are now hoping that the market goes back at least to break even so they can sell. And that's why I'm a big advocate of buying things with a margin of safety, no matter how amazing the company is. But I sidetracked. I wanted to show you this. So I wanted to show you this. And another chart that I wanted to show you is this one, the global stock market valuation. This is the Schiller Cape NPV. And you can see this is so the countries with the most expensive, it shows you the most expensive and cheapest stock markets. Look at the US and India off the charts. Look at this. Yes, and this data is quite recent. This is from, so this is, you can see it down below, right? So this is December the 30th, 2024. And you can see, for example, if we compare this to China, look where China is. So you have a US market that is at the most expensive levels, at one of the most expensive levels of all time. And then you have certain markets like China, which are trading at the cheapest valuations ever or close to it. And so this is what I mean. This presents opportunity. And it's not a coincidence that Alibaba is just been it's just been skyrocketing. Speaking of Alibaba, let's go back because I want, in this ties into one of my next videos, which shows why I believe emerging markets are going to continue to outperform the US markets in the years ahead. And part of the thesis is that the US markets are very expensive. And so as the US market continues to decline, you're going to see more investors pull money out of US equities and into emerging markets like China. So I think that's going to be that's going to continue going forward. But I mean, I wanted to show you this, and of course, here we have our portfolio. You can see if I go back to Alibaba, it's a bit slow. Sorry about that. But you can see right now this is all consolidation. I haven't sold a single share because I think we are going to continue to move higher, and especially. One thing that I also want to discuss is the US dollar, because if we look at the US dollar as a currency should continue to struggle. In my opinion, that's going to continue to happen. So if I go here, this is the dollar, and we are now, look at that. Look at this massive drawdown. Again, if you've been following me, you know that I've been saying that the US dollar was overvalued, and that this should continue. It was primed for a decline, and sure enough, that's what we are seeing. And I still think we're going to continue to see that. And look, 2025 is going to continue to be a year of great volatility, especially with tariffs and all the things that are happening, wars. There's so much going on, but all the more reason why you should be cautious in terms of what price you are paying for stocks. Now, to finalize, and I wanted to tell you exactly what I'm doing. And I just shared a post on social media, which essentially details how I plan to triple my net worth in the next market crash. And again, I'm not saying we're going to see a market crash, but we are already in correction territory. Remember, the Nasdaq, I think, is down some like 20%. In anything beyond that is considered to be a bear market. Okay, so it's very simple, and you have to be able to. Investing is not difficult. What's difficult is to remain emotionally detached from everything that you are listening and from everything that you hear other people saying. Just stick to your guns. If just what I'm doing at least is I have a watch list of about 30 companies, and these are all amazing companies that have passed my criteria for high quality. And I mind them. And once if there continues to be the sell-off that I'm talking about, and those price levels are reached, then I'm going to buy them. Sure enough, I'm not going to buy all of them, but because I run a concentrated portfolio. But I definitely want to add a maximum of 7 names, and right now I only have 4, and so. Do your own due diligence. Select the companies that you believe are going to come out stronger at the end of this crisis. Because what happens is, in a crisis, all companies typically struggle. That's true, but the companies that are weakest in their respective industries, those are going to go out of business, and that will allow the bigger players, the companies we personally want to invest in, to consolidate and actually to come out stronger. So how I plan to triple my net worth is very simple. So again, patience and discipline. Build that watch list. As you can see here, strong watch list. Only companies with strong balance sheets, high returns on capital, competitive advantages, great management teams. Some of these companies have been around for the last 10, 20 years, and you can go back and see how they performed during other crises, and typically they even managed to be profitable during that time, and that's a good thing to know. And then, of course, you have to put a value on all those companies, right? Price is what you pay, value is what you get, remember? So put a value on those companies. But then what I think is very, very important, especially in this environment, is you will need to apply a margin of safety. In my case, that means 50% of the real value of a company. And the reason for that is you need to account for the uncertainties, for the black swans that can happen going forward. And there's so much that can go wrong with your investment thesis. Remember, investing is just as much science as an art. And that's why we need to protect always our downside. And what happens is, what I've personally experienced is, when you happen to buy a very high quality company at such a low valuation, then and you buy it with a margin of safety, not only will you protect your investment on the downside, but you will maximize your returns on the upside once the market reprices that company. And look, patiently wait for the right price. It's the time for the tortoise. All right, the tortoise will walk. It will be consistent. It will take the necessary steps to get to the finish line, but it will get there no matter what. And that's exactly how I intend to benefit from this environment. So, I hope it was helpful. And over the next few days, I will be posting. I already discussed my largest position, Alibaba. And I'm reading PayPal's annual report right now, which I intend to finalize over the next few days, of course. That's the company that I want to discuss in the next video. So keep tuned in. Let me know if you in the comments if you like everything that was shared, the content that I've been putting out, and if you find it valuable. And that will definitely help the channel, and it will help me grow my presence here. Cheers.